Hey, what's up, stock compounders? Brad here. So I just watched Mohnish Pabrai's Q&A with the University of Georgia, and I want to share my highlights from the hour-long Q&A session. There was no monologue as part of this one. Pabrai just went right into the Q&A. So at first he was asked about his lunch with Warren Buffett and really his relationship with Buffett and Charlie Munger. He pointed out in 2007, Pabrai's net worth was $80 million, okay? He says almost all of it I would attribute to me using the intellectual property of Warren Buffett without paying any royalties. So that lunch for Pabrai was really, Pabrai paying the tuition bill to Warren Buffett for so many years of learning and building wealth on the back of the IP of Warren Buffett. I really like, going into a lunch with Buffett with that kind of mindset. My only purpose here is to thank him for all of that incredible learning. And that still, to me, comes out through Pabrai's Q&A videos, all of the education that he puts out to the value investing community is phenomenal. I think he's still paying it back. He still has that ethos of paying it forward. How do we expand circle of competence? This is something he's asked about often. He usually says, if you're not sure if it's in your circle of competence, it's not. But, his response in this particular Q&A I thought was a little bit more helpful in terms of, how can students just getting started in investing expand the circle of competence? He says, focus on products and services you already use regularly, okay? For a brand to come through and be something that you trust and use is a very high bar. The vast majority of businesses don't make it to the point where you're paying them money every month, right? You're paying to use that product or service. So that is a high bar, and it usually indicates that there's some moat there or the business has some special sauce. He says the business usually has to have some very special attributes and characteristics to get there. So those are businesses worth studying. He's asked, so this is related to circle of competence, just what resources does he use to further his learning, podcasts, books, things like that. He says the best approach to learning is as a gentleman or gentlewoman of leisure. So Pabrai is really just following his curiosity, okay? And that leads him to many different resources in many different formats. He does read a few newspapers every day. He didn't mention in this talk, but I think he's mentioned in the past what those newspapers are. He loves reading biographies and autobiographies on great business leaders. Okay, you can just learn a ton from incredible CEOs from the past, studying businesses that, had turned into these long-term compounders. What lessons can we glean from those? He's looking for an aha moment when he's trying to decide, is this something I should include in my investment portfolio? Is this investment really going to move the needle? And that aha moment is a big insight that most other market participants don't quite get, right? They don't understand. It's something that you see about a business that most other people don't see. If that insight is meaningful and valid, okay, it can provide a big edge as a stock picker, right? For us concentrated investors. And we don't need that to happen more than once a year, okay? So, it's common. I see people are always looking to add more and more ideas to the portfolio. They want this heavy diversification, right? But really, all you need is one idea, one great idea each year, and you can just crush it. You can knock it out of the park as an investor. So, I think that bar needs to be set pretty high, right? If we're making 5 or 10 new bets each year, the bar probably isn't high enough, and we would probably do better to follow more of a punch card approach where we're thinking very long and hard before adding a position to the portfolio. He's asked about leverage. The short answer, it's best to eliminate leverage in your personal portfolio, okay? No margin debt. Now, there was a guy, Rick Guerin, who was part of the tribe with Warren and Charlie once upon a time. Rick was, he was borrowing on margin in his portfolio. And I think this was 73 or 74. There was a big crash in the market, and he ended up having to sell his shares of Berkshire Hathaway. I think he sold them back to Warren Buffett. And the opportunity cost there is just incredibly high. Being forced to sell when the market takes a dive. And that's really what we put ourselves in position for when we use margin in the portfolio. So very important. Businesses that have leverage are less likely to make it through difficult times. Okay. Same with a business as it is for us individual investors. If we're over leveraged, if we're using too much debt, we can be forced to close up shop at the worst time, right? When everything is going wrong, everything's taken a pounding, that's when you've got to liquidate. And that's really not when we want to be selling assets, when things are at a low, right? When the market has crashed. But we don't have control if we're over leveraged. He's asked about macro. Or he's often asked about macro. Investing is difficult enough if you're just trying to understand a business and how it works. When you start overlaying and trying to make projections about interest rates, unemployment, recessions, all of these macro issues, all of those things most people are wrong about, okay? It just makes investing much more complicated. And it's, from Pabrai's perspective, it's much harder to excel at the craft of investing when you're trying to incorporate all of those factors into the investment framework, when it's much harder to be right about those things than it is about a particular business. So really important thing to keep in mind there. How do we evaluate management? For Pabrai, it's quite simple. Look at what management said they were going to do 20 years ago, okay, or however long the management team has been around. Check up on them, maybe every decade. What did they say they were going to do? What were their ambitions? And then see what actually happened, right? So we're looking back in time here. Did they do it? Did they underpromise and over-deliver, or was it the opposite? So you can really gauge both the skill and the honesty, the trustworthiness of management by looking at what they said they were going to do and how it worked out. And if it didn't work out well, did they own that or did they make excuses? So a lot we can read into the character of these management teams through past promises or goals. He's asked about, let's just read this. The factors that affect a business are so wide-ranging. You want to make sure you've honed in on the stuff that is likely to happen and understand the likely implications if that stuff actually happens. And it cuts across many disciplines, okay? This is what makes investing so exciting for Pabrai. It is such a multidisciplinary endeavor. Charlie Munger, he's constantly reading, right? I think his kids call him a book on legs. So it's endlessly demanding in terms of the best investors, the investors who can really compound capital at high rates over many, many years. They are very curious people, and they are constantly reading across many disciplines, not just business books, but biology, physics, the hard sciences, psychology. It's really all encompassing. So that's part of what makes it endlessly fascinating, endlessly interesting. He talks about greed here. The greed portion of our brain can sometimes mislead us. So it's very important to have circuit breakers on greed. Okay. One of the circuit breakers that Pabrai uses for greed is a pre-investment checklist. He has 160 to 170 questions. So he has a new investment idea. He runs through these 160 questions, and 10 or 20, he's going to realize, I don't know the answer to these. So before he goes any further, he has to find the answers to those 10 or 20 questions. Once I can answer all of the questions intelligently, the checklist has done its job. And what the purpose of the checklist, it's really to point out blind spots, to point out, where things could go wrong, where there could be things that cause permanent loss of capital. And that's really the primary focus for Pabrai. When making an investment, how can this business lose money for me? And how likely is that to happen? When you focus on the downside and make sure your downside is limited, the upside takes care of itself. Asked about cloning. All right. Pabrai is known as the shameless cloner. He says it's a big advantage to be able to leverage what other people have already figured out. Right. That's what cloning is all about. Instead of looking at the entire universe of public companies, focus on what have great investors bought recently. That's going to narrow it down to, say, 50,000 public companies, down to maybe a couple hundred, maybe even just a few dozen, depending on how active that quarter is for the investors that you follow. So obviously, for something to make it in to a great investor's portfolio, and Pabrai uses Chuck Akre and Bill Ackman as examples, it's got to make it through a bunch of filters, okay? Which is already a huge advantage for us if we're only looking at opportunities that have already made it through a number of filters for these great investors. So what 20 stocks have the 10 or 15 investors that I follow bought recently? Okay, 20 stocks. It's a very manageable number of companies to look at each quarter. And there's a few initial filters that really speed up, where we want to spend our time. Which ones can I understand, right? Out of those 20 companies, I might only be able to understand 3 or 4. So that cuts back on the list right off the bat. Which ones are great businesses? Okay, I can look at some of the metrics that Terry Smith uses to identify great businesses. What is the return on capital employed? Has that been consistent over time? What are the gross margins? How much ability to raise prices does this business have? Particularly important in our current environment, where inflation is a concern. Which ones are great businesses? Maybe that cuts it in half. And then, is the valuation reasonable? Okay, is the price at nosebleed levels, or is it a fair price for a great business that's already made it through all of these filters of great investors? And one way to get a sense for that, is it a fair price? Look at what was the low in the quarter where the great investor bought it. And if it's around there now, or even lower, that's a pretty positive indicator that it may be reasonably priced today, as opposed to nosebleed prices. You only need to find one IEX, that's Indian Energy Exchange, a company Pabrai talked about a little bit in this Q&A. You only need to find one IEX or one American Tower. And if you're right about that runway for 30 or 40 years, just sit there and let it rip, and you're done, okay? We only need one great investment in the portfolio, assuming we have a fairly concentrated portfolio, maybe 5 or 10 positions. But if we just get one right and we have the discipline to ride that company over many decades, that's going to get you to the promised land. So awesome Q&A from Pabrai. Definitely check it out if you haven't seen it yet. I will link to it in the description. And many, many thanks, Mr. Mohnish Pabrai, for all of this incredible knowledge, wisdom that you're sharing with the value investor community. So happy holidays to all of you. You guys are going to see many, many more videos from me before Christmas and New Year, whatever holiday you're celebrating this month. But just wanted to take a moment. Happy holidays. I hope you're all safe and feeling healthy and connected with family and friends. So with that, I will leave you all till the next video. Take care.